According to data from Moody's Analytics, green bond issuance is expected to hit $375 billion this year. It's up 40% from last year's issuance, but still just a small part of the $4 trillion muni bond space. Here with more on the changing dynamics of this market is Mark Kim. He's the CEO of the Municipal Securities Rulemaking Board. Mark, it's good to have you. And I guess the first thing to ask is, what's a green bond?
Sure. Kelly, thank you for inviting me on CNBC's The Exchange. It's a pleasure to be here with you. To answer your question, what is a municipal green bond? It is targeted towards investments that are aimed at achieving certain environmental outcomes or aimed at achieving environmental sustainability. And we are seeing a growth in municipal green bond issuance by state and local governments to meet that rising demand from investors for this type of investment.
So I read, though, that there's no universally accepted market standard or definition of what makes a bond issuance green. So, is that itself a problem, or is that, you think, part of the evolution of the space? There was only $2 billion in this kind of issuance a decade ago. What real-world examples have these bonds financed?
So these bonds have financed both climate resilience, so looking at building the next generation of infrastructure that is more resilient to the impacts of climate change. These types of investments, these bonds, are also financing clean energy and other projects that lead to a more sustainable future. If you think about the impacts of climate change, whether it's wildfires on the West Coast, hurricanes on the East Coast, it is our state and local governments that are on the front lines of battling climate change. And the investments that they're making in infrastructure are largely going to be financed through the municipal bond market, which is why green bonds make sense for the muni market.
So there's a couple of things that I'm thinking about. Is the appetite for green bonds driven by people who need ESG approval for their portfolios, in other words? On their own, a lot of these investments would seem to make financial sense anyway and would attract investors anyway. So what is the importance of this distinction? Is it to just bring extra sort of investors into this space, or are they potentially giving up some returns in order to step a little bit out there in terms of some of the financing for these projects?
So I think there's an argument in the market that ESG, environmental, social, and governance factors, are totally separate from investment decisions. And I think we're seeing a maturing and an evolving muni bond market where investors are integrating ESG factors into their investment decisions and consider them material to make investment decisions. We're also seeing other market participants incorporate and integrate ESG factors into their business models. For example, all of the major credit rating agencies in the muni space now either provide an independent ESG score in addition to the credit rating, or they're incorporating ESG factors into their underlying fundamental credit analysis. We're seeing fund managers. In fact, recently, we saw the very first sustainable muni bond ETF launched a few weeks ago. We are seeing fund managers now incorporating ESG factors into their individual security selection and their portfolio valuation models. So it's no longer something that is happening independent of the investment decision. It is actually being integrated within the investment decision itself.
Well, like you said, a lot of these places are on the front lines, seeing the impact of, storms and unseasonal weather patterns and, really suffering as a result. So I can understand the multiple factors driving this. And it's a reminder as well, no matter the fate of the infrastructure bill, there are a lot of other financing avenues out there to kind of push this ball forward. Mark, thanks for joining us today. We appreciate it.